while Warren from Massachusetts is recognized.
Thank you, Mr. Chairman. Every time you log onto a website, big tech companies collect extremely detailed data about your spending habits, your physical location, your health status, your political beliefs, your religious beliefs, and more. And every 30 seconds, big tech companies auction off that data to the highest bidders here and around the world. Now, Americans' data are broadcast in this way 107 trillion times, that's trillion with a T, every year. This doesn't just pose a risk to Americans' privacy, it also poses a risk to our national security. Reports have found that some buyers of our data build huge dossiers of extremely personal information about U.S. government officials and military service members. They then turn around and sell that information to companies in China and Russia, where the Chinese and Russian governments can access it without our even knowing anything about it. Ms. Gilcrease, you've spent years in government service working on issues like data security policy. So when China or another foreign government gets their hands on our data, what can they do with it?
Well, nothing good comes out of that situation, Senator Warner, so thank you for the question. There's a range of national security risks that can arise from the unfettered transfer of that sort of information on U.S. citizens. To take one example, there's certainly been public reporting about Fitbits on U.S. soldiers being used to enable the movement of our troops. That's a clear national security concern. And when you think about the types of personal information that's available online and can be collected and sold, as you note, you can think about enabling blackmail. You can think about enabling cyber exploits. It's just a massive counterintelligence concern, essentially, when that level of information is for sale on the open market about individuals who are in these sensitive positions.
But big tech tells us that it is helping us when they sell or store your data however they want, wherever they want, because it will improve your online shopping experience, or they claim it will help keep your data safe. In reality, the only winners are foreign governments and the tech companies themselves. Harvesting more of your data means you get more targeted ads and big tech gets more revenue from those ads. And as part of the bargain, foreign governments, our adversaries, get access to compromising information about U.S. military and government personnel and their families. Now, Congress and the Biden administration have plans to address those risks, and big tech companies know this. That is why they are hijacking our trade agreements to slip in provisions that would prevent policymakers from limiting big tech's ability to transfer our data wherever they want. Now, the big tech lobby likes to say, don't worry, Congress could still act to protect Americans' data under certain exceptions, like if there is a, quote, legitimate policy or national security need. Ms. Gilcrease, in theory, the exceptions that big tech companies want us to rely on would give policymakers some ability to override the data provisions that big tech slips into trade deals. But of the 48 times that countries have invoked a public policy exception at the World Trade Organization to protect their domestic policies, how many times has it actually worked?
I think when those sorts of public policy exceptions are raised in the WTO context, not speaking for when the U.S. government raises it, because presumably we are always acting with legitimate public policy and national security interests in mind, but I understand that the number is fairly limited in terms of the ability to...
Do you happen to know the actual number?
I believe it may be 2, ma'am.
2. So twice out of 48 times, this exception has actually been worked, just 2 times. I got to say, I don't like our chances on using this exception. And the national security exception is no more reliable. Trade law tribunals have consistently ruled against the U.S.'s use of this exception. Unaccountable trade tribunals should not decide who gets access to information about American soldiers and about our national security. And big tech companies cannot be allowed to co-opt trade policy for their own benefit, especially when that means continuing to allow the Chinese and Russian governments easy access to personal data about U.S. government officials and our military, putting our national security at risk. American data policy should be decided by the American people through their representatives right here in Congress, not by trade tribunals, not by trade negotiators, and certainly not by big tech. Thank you, Mr. Chairman.
Senator Warren, Senator Reed of Rhode Island is recognized.
Institutions that are receiving fraudulent payments responsible and make sure that payment systems are doing more to protect consumers as well.
Great. Thank you so very much.
Thank you.
Thanks, Senator Warnock. Senator Warren of Massachusetts is recognized.
Thank you, Mr. Chairman, and thank you for holding this hearing. So, cyber criminals are exploiting cryptocurrency to scam American consumers out of billions of dollars every year. According to the FBI, Americans are reporting losing more money to crypto-related investment fraud than any other kind of investment scam. In 2022, that amounted to reported losses of more than $2.5 billion, and that was up 183% in just 1 year. Now, according to the Federal Trade Commission, since 2021, crypto has accounted for about 1 in every $4 that consumers report losing to fraudulent schemes, more than any other payment method out there. So let's focus today on one type of cryptocurrency, stablecoins. Stablecoins like Tether and USDC are supposedly pegged to the dollar or other assets that are relatively stable. And this is supposed to make stablecoins safer and less volatile than other tokens, kind of the responsible big brother of crypto. But new data show that stablecoins are now used in the majority of illicit crypto transactions, especially in the scams. Last year, more than 70% of the crypto scams that we know about involve stablecoins. So, Ms. Sanchez-Adams, as a consumer protection expert, does it surprise you that stablecoins are increasingly being used to scam customers?
No, as you said, stable coins are not as stable as they claim, and they really are primarily a gateway to support unsafe and dangerous crypto assets. So it's to get them into the door to do the crypto.
All right. So crypto scams, as you know, takes a variety of different kinds of forms. Pig butchering, a kind of romance scam where criminals build up a personal relationship with their targets online and then convince them to invest money in fake crypto platforms before stealing the money. Many of these scams are perpetrated by sophisticated criminal organizations based in Asia, including North Korea. Mr. Benda, you are an expert on cybersecurity. What is it about crypto that makes it such a good tool to scam people out of their money?
Yeah, so the challenge we have is that these cryptocurrencies operate outside the banking system, operate outside of regulation, operate outside of BSA AML. Additionally, the technology is there that allows you to mix and hide transactions. So you can go into that crypto ecosystem and you can actually obfuscate where that money goes after that. And additionally, you can put things together what are called cold wallets. So you could download millions, hundreds of millions of dollars onto a single USB and transfer that internationally without anyone knowing anymore.
Wow, it's a lot to be able to hide. You know, we can't keep making it easy for criminals and for countries like North Korea to defraud Americans out of their hard-earned money. 20 senators, both Democrats and Republicans, are sponsoring the Digital Asset Anti-Money Laundering Act. This bill would plug the holes in our anti-money laundering rules to make it easier for financial regulators to track suspicious crypto activity, to make it more visible, and to shut down the scammers. So, Mr. Brea, your organization, the National Consumers League, has been protecting consumers for over 100 years. Would this bill help protect American consumers from crypto fraud?
Absolutely, yes, Senator.
Want to say a word more?
So cryptocurrency is certainly the next frontier when it comes to payment scams. It offers a scammer's dream, anonymity, immediacy, irrevocability. And because of the availability now of cryptocurrency kiosks in convenience stores, grocery stores, smoke shops. I mentioned earlier, by one estimate, there are more than 34,000 of these kiosks across the country. The ability to send cryptocurrency to scammers is usually just down the block for the vast majority of Americans. So yes, your bill would do much to protect consumers.
Well, thank you, Mr. Breo, and thank you to the National Consumers League. We are very grateful to have your endorsement from your organization. I also want to say thank you to the National Consumer Law Center, Ms. Sanchez-Adams. Our bill will help protect consumers and protect our national security, and I look forward to working with my colleagues on this committee so that we can get it passed. Thank you. Thank you, Mr.
Thanks,
Chairman.
Senator Warren. Senator Fetterman from Pennsylvania is recognized.
Well, thank you.
Thank you, Mr. Chairman.
Senator Warren of Massachusetts is recognized.
Thank you, Mr. Chairman. It's good to see you, Secretary Yellen. So today I want to talk about the one percenters, not the billionaires, but the billionaire banks. America has more than 4,700 banks, but the ones that have the power to crash our economy and the ones that get government bailouts are not the community banks. No, the ones that pose a threat are the giant banks, the multi-billion-dollar banks. So the Fed has proposed increased capital standards to make these giant banks hold more capital. And it turns out that even among those billion-dollar banks, nearly 90% already hold enough capital. So what we're really talking about here is just a handful of the biggest banks that would have to hold a little more capital. Secretary Yellen, I just want to start by making sure I've got my facts right. Would the new Basel III rule on capital standards have no impact on community banks and, in fact, only make a handful of giant banks hold more capital?
Well, its terms apply to banks with more than $100 billion or significant trading activities, and community banks have far lower assets, and I'm not aware of any who have those.
So this is not about our community banks.
Not about.
This is about our biggest banks. Why is it so important for these giant banks to hold more capital?
Well, capital is a measure of the resources a bank has to absorb losses in the face of a shock. It's, even in normal times, capital is something a bank has to have in order to lend, and so it's critical to meeting the borrowing needs of households and businesses throughout the economy. When a shock hits, like we saw in the financial crisis, a bank can fail if it runs through its capital. And if it's a large bank or one that is highly interconnected to other financial institutions, its failure can have devastating consequences for the financial system as a whole. The failure of one bank can transmit huge problems to other banks that it lends to or borrows from. They too can fail, and we can see an event like the 2008 financial crisis. And when you have such a financial crisis, it can cause enormous economic toll. We saw that when we hit near double-digit unemployment, when the financial system collapsed. It hits hardworking Americans. It hits businesses that really had nothing to do with any of the activities that caused this.
Okay. So higher capital
important.
standards are about making the bank safer, but it's about making all of us safer, right, basically?
Yes, because it diminishes the odds of a systemic financial
Of a systemic failure. And that's why it's so important for these big banks. And look at what's happening today. Less than a year after 3 billionaire banks collapsed, another one, New York Community Bank, is now teetering. So we're just trying to make sure that these giant banks don't go broke and come back to the American taxpayer like they have done before to get a bailout. But the big banks like JP Morgan, Bank of America, Citi, and Wells Fargo are fighting back hard against these capital standards. They've spent millions of dollars lobbying. They're even running ads during the NFL playoffs, claiming that if they have to be a little bit safer, it will somehow raise grocery prices for American families. You know, in other words, they want us to believe that big banks are really worried about Americans' grocery bills. Nobody believes that. So the question is, what is this really about? The answer is profits. If giant banks have to hold back just a little more capital, that could bite into their buybacks and their executive compensation. In fact, Morgan Stanley recently said it out loud. The banking lobby is fighting to water down the capital rules so that these giant banks can create, quote, a significant increase in buybacks. Secretary Yellen, let me just ask, do you happen to know how much money the 4 biggest banks returned to their shareholders through stock buybacks and dividends over the last decade?
My guess is it's a large amount.
It's a lot
but
of money.
I don't know the exact figure.
I actually looked this up, $630 billion. And do you know how much the average CEO pay at these big banks was in just 2022, just in that 1 year?
Yeah, I'm not sure. My guess would be around 30 million, but
It was 28 million. You're very, very close there. So higher capital requirements may mean fewer stock buybacks. It may mean somewhat smaller bonuses for the CEOs. These giant banks say that they will stop making mortgage loans if they have to hold a little more capital. But I got to say here, who can trust these guys? In 2020, Jamie Dimon at JP Morgan made big headlines when he pledged to make 40,000 mortgage loans to Black applicants. 40,000, that's a lot. More than 3 years later, how many loans have they actually made to Black applicants? 122. Yeah. So that's what this is all about. The biggest banks want to be able to push hundreds of millions of dollars out the door to investors and CEOs, while the banks take on more risks. And then when things go wrong, and they will go wrong, they want taxpayers to bail them out again. And they claim that if the Fed doesn't cave, people's groceries will cost more. You know, I am sick of bailouts, and I am sick of banks that lie to the American people. We need stronger capital rules to reduce the need for bailouts, and I urge our regulators to finalize these rules as quickly as possible. Thank you, Mr. Chairman.
Thank you, Senator Warren. I heard Senator Warren of Massachusetts is ready.
Thank you, Mr. Chairman. So it's been a year since we had the second, third, and fourth largest bank failures in American history. Greedy bank executives were part of the problem, and the Fed, as the chief regulator of the biggest banks, was part of the problem. Under your leadership and direction, the Fed steadily weakened rules for the biggest billionaire banks, exactly the banks that failed last March. In other words, Chair Powell, you failed to do your job to keep these big banks in line. Now, when these banks blew up, you went into spin mode, promising that the Fed would do better. After years of hemming and hawing, you finally agreed to put in place Basel III rules that would strengthen capital standards for the biggest banks. And I mean the biggest banks. The Fed's proposed rule would apply to only 37 of the nation's 4,500 banks, only the banks that have $100 billion or more in capital. Now, Chair Powell, when you testified before this committee last June, I asked you about taking responsibility for bank failures. And you said, quote, "The main responsibility I take is to learn the right lessons from this and to undertake to address them so we don't have a situation like this where we had unexpectedly a large bank fail and spread contagion into the banking system," end quote. And as part of learning those lessons, you also said, quote, that you agree with and support, end quote, Vice Chair for Supervision Barr's recommendations for strengthening the Fed's rules and supervisory practices for the big banks, and that you're, quote, confident they will lead to a stronger and more resilient banking system, end quote. So I just want to be clear. You haven't backed down from any of your comments from a year ago, have you, Chair Powell? Right lessons, don't let this happen again, supporting Vice Chair Barr's recommendations, which include stronger capital standards.
No.
You still stand by all that?
Yeah.
Good, good. I'm glad to hear that. Now, I understand that those 37 big banks don't like higher capital rules because they are like insurance. You know, they would make the banks safer, but they cost a little money and would nip into the bank's profits. So these 37 banks are swinging their very considerable weight around to try to weaken the capital rules. They've spent tens of millions of dollars running ads during Sunday night football and millions more for an army of lobbyists to try to twist arms here in Congress. Impressive spending, but who exactly are they trying to impress? A man on the inside? You know, despite all you said last year when the banks failed about supporting Vice Chair Barr's recommendations to strengthen rules for big banks, public reporting now says that you are driving efforts inside the Fed to weaken the capital rule. You even told the House Financial Services Committee representatives yesterday that you think it's, quote, very plausible, close quote, that you withdraw the rule. As one analyst put it, quote, I don't think they will pass a final rule without Powell's support, suggesting that the rules will have to be weakened, quote, to appease Powell. So, Chair Powell, I'm having trouble reconciling the statements you made last year, which you say you hold on to, statements you made when the headlines were all about 3 giant bank failures, and now your reported efforts to quietly weaken the rules that would strengthen capital standards for giant banks and prevent more bank failures. So let me just give you a chance to clarify the record here. Are you committed to finalizing the strongest version of the Basel III capital rules this year?
Let me first say that we have taken and are taking many more steps to deal with the problems that revealed themselves with Silicon Valley Bank, and that's around supervision. We'll have a strong liquidity.
I appreciate that, but I'm just asking about the Basel III rules, the ones that you have been required for years now to put in place and have dragged your feet on.
The Basel III rules are not directly related. They're not the thing that is directly related to Silicon Valley Bank. As you point out, they're a longer run thing, and I would just say that we put them out for comment. We got the comments. Anybody's free to go read the comments. My view is that it will be appropriate to make material and broad changes to that before we finalize it. And in terms of, I didn't say that...
Material and broad changes to strengthen the rules?
Material and broad changes, and we're talking about what that'll mean in the end. I did not say that we would withdraw the rule. I said, there's a concept of reproposal, and I said we hadn't made a decision on that, but that if that turns out to be appropriate in the view of the Board of Governors, then that's something we would look at doing.
So everything you said a year ago about supporting the vice chair who is responsible for writing these rules?
You and I had a long colloquy.
Yes, we did.
If you read it again, it's on your website.
And I have.
You will see that I'm doing exactly what I said I would do in that colloquy.
You said you would support Vice Chair Barr to get us strong rules, and now he is putting out rules, and you're talking
Silicon
about
Valley Bank.
reproposing.
The Vice Chair for Supervision has every right to bring proposals to the board. That has happened, but as I made clear in our colloquy, you're not the comptroller of the currency. When I do monetary policy, I have one vote. There are 11 other voters, and that's the way it works. It's not different for the Vice Chair for Supervision.
You are the leader of the Fed, and when the heat was on last year, you talked a lot about getting tougher on the banks, but now the giant banks are unhappy about that, and you've gone weak-kneed on this. The American people need a leader at the Fed who has the courage to stand up to these banks and protect our financial system. Thank you, Mr. Chairman.
Warren,
And with that, I yield back to, Madam Acting Chairman. Thank you.
Thank you. So we're in the middle of a housing crisis all across America. Today, though, I want to focus on the housing crisis in Indian country. The federal government has failed to live up to its promises to tribal nations. And one of the ways that we've fallen short, we have woefully underfunded programs for Native communities. In the 25 years since the Indian Housing Block Grant Program was created, Congress has consistently failed to put enough money into the program, even to keep up with inflation, let alone the massive housing needs in Indian country. Ms. Bailey, you are an expert on the housing needs of historically marginalized communities. How have tribal communities been affected by the federal government's failure to adequately fund tribal housing programs?
Thank you, Senator. This is such a critical issue that we don't talk enough about. For tribal nations, housing quality is a huge issue. We haven't helped them invest in housing and in order to keep their properties from deteriorating. Housing overcrowding is an issue, and homelessness in general shows up differently in Indian country than it does in non-tribal areas. So this investment has been is critically important to highlight.
Okay, so poor condition of the housing, a lot of homelessness, a lot of overcrowding. You know, the federal government's refusal to provide basic funding to Native communities is one of the reasons that I introduced my Honoring Promises to Native Nations Act back in 2022. One of the core promises of that bill is that tribal communities should be entitled to 5% of federal dollars, as tribal groups have demanded for years, in order to fulfill the federal government's trust and treaty obligations. Today, as this committee considers proposals to address our housing crisis, I am reintroducing rural housing service provisions from the Honoring Promises as a standalone legislation. The Tribal Rural Housing Access Act would set aside 5% of rural housing service funds for tribes, Native community development financial institutions, Native-owned entities, and tribal members. My bill has been endorsed by Native CDFI Network, National Congress of American Indians, National American Indian Housing Council, Housing Assistance Council, and National Rural Housing Coalition. Ms. Bailey, you've had a chance, I think, to look at my bill. Would my bill help address some of the housing challenges faced by Native communities?
Absolutely, it would. It's our understanding that only about 1% of these resources currently go to tribal nations. And so being able to increase that to 5% would make a huge difference in all of the areas that are necessary in tribal lands. I think another thing that is important that I want to highlight is in order for them to be able to spend those resources, it's critically important for us to look at how the Department of Interior, the Department of Justice, and HUD are working together. We've got to improve the bureaucracy and streamline that so that we can truly honor the nation-to-nation relationship we should be having with tribal nations.
That's a very powerful point. I want to underscore, though, in my bill, this wouldn't cost the federal government an extra dime, but it would go a long way to beginning to fulfill our trust and treaty obligations that we have ignored for so long. Other members of this committee have already done important work on this issue. Senator Smith and Senator Rounds have a bill that would set aside funds for Native CDFIs to administer the 502 Direct Loan Program, which plays a critical role in helping low-income individuals buy and rehabilitate homes. Our bills go hand in hand. My bill counts every dollar of Senator Smith and Senator Rounds set aside toward my 5% set aside, and it sets aside funding for tribes in other rural housing service programs as well, including housing subsidies for farm laborers. Let me be clear. We need a major federal investment to increase our housing supply if we want to get out of this affordability crisis, and a 5% set aside for tribal communities would be an important start. Thank you, Mr. Chairman.
Thank you, Senator Warren. I will ask my questions now. Welcome again. Thanks to the committee members on this committee.
Your employees show up. Thank you, Mr. O'Malley.
Thank you, Senator Warren.
Thank you, Mr. Chairman. So when American workers pay for Social Security, I think they deserve to know that they're going to get the benefits that they earned. And that is why President Biden and Democrats in Congress are fighting to protect and to enhance Social Security, funded by making the wealthy pay their fair share. But today I want to focus on an issue that doesn't get much attention, and that is state government seizing Social Security benefits for foster youth, often with the help of predatory private contractors. Now, some people might say, wait a minute, you're talking about children getting Social Security? Well, we have to remind people that 500,000 children are in the foster system, and some of these are children with disabilities who need extra care, which makes them eligible for supplemental security income. And many foster children have lost a parent who had worked and paid into Social Security, which would make these kids eligible for survivors' benefits. Commissioner O'Malley, you've worked in government your whole life fighting for working families, and now you head up the Social Security Administration. Do you agree that when a parent dies, a child deserves and often desperately needs the Social Security benefits that their parent earned?
Absolutely.
Yeah. So the law says that Social Security survivors' benefits must be used in the child's best interest for unmet needs. And yet, if that child ends up in foster care, their benefits may be seized by state agencies that are responsible for taking care of them. States, with a little help from the federal government, fund the foster care system, but dozens of states are now secretly screening the kids in their care to see if they would be eligible for Social Security benefits, sometimes even hiring data mining companies to try to identify targets and then funneling those Social Security benefits into state coffers to pay for anything from paper clips to prisons. In 2018 alone, states took at least $179 million from foster kids, and in many cases, these children didn't even know that they were entitled to the money. Commissioner O'Malley, when I heard about this, I nearly fell out of my chair. Funneling a foster child's benefits into state coffers and not directing an additional cent toward improving that child's life, does that sound like it is meeting the legal requirement that those benefits be used in that child's best interests?
It certainly doesn't sound like the sort of policy outcome that any of us would like for kids in foster care, regardless of whether or not the law says legally they can.
All right. Well, I got even a question about whether or not the law says they can.
Okay.
The law is very clear that those Social Security benefits are to be used for that child. You know, and these kids are not rich. Quite the opposite. A few $100 a month could make a huge difference in the life of one of these children. Could pay for trauma counseling, specialized tutoring, save for college, save up money for a down payment on an apartment because they're going to get dropped from the system when they turn 18 and have nothing. So here's the good news, Commissioner O'Malley. SSA has the power to ban states from stripping away foster kids' earned benefits. So let me ask you, what are your plans to ensure that foster children's Social Security benefits are used for their own needs rather than siphoned off by agencies and for-profit data mining companies?
Yeah, we're taking another look at this policy. There are some 17 states, led by Maryland, that have either passed laws or are considering laws that would require a certain amount of those benefits be conserved for the child. There's probably a lot of states who would tell you that if a child is in foster care, they pay more than what the benefits are that that child is receiving. So they would argue with their lawyers that they are using it for care and maintenance, as indeed grandmother or another family member might for care and maintenance. But when we all know what terrible outcomes kids aging out of foster care have, and we know that at least for this portion of them who receive benefits, there's a better way, we should do what we must so that when that kid ages out of foster care, having had benefits, that they're not just given a pat on the back and their clothes in a plastic bag when they turn 18.
Well, I appreciate your attitude on this. You know, seizing the benefits that go to some of our most vulnerable children just to finance other parts of state government just isn't right. And I hope you will pick up all of the tools available to you at the federal level to make sure that those kids get what their parents were promised back when their parents paid into the Social Security system.
And I'm looking forward to continuing to work with you. We're unpacking some of this. And, 34 of the states claim that they do conserve a portion of it.
Yeah.
But we're about to find out exactly how true that is in the research that
And
we're doing.
remember, you've got the federal power.
Yes.
Thank you.
Senator Warren, my state, Oregon, has led the country in protecting these kids, and I understand our staffs are talking, so we'll follow that up.
Senator Warren of Massachusetts is recognized.
Thank you very much, Mr. Chairman. It's good to see you, Deputy Adeyemo. And thank you, Senator Tillis. I just want to follow up in the same area. And if I can, I want to lay a little background here. In November, after reports that Hamas had received millions of dollars in crypto funding in the months before its terrorist attack on Israel, Treasury wrote a letter requesting Congress's help in closing the gaps in our anti-money laundering rule. Deputy Adeyemo, can you explain why you sent us this letter? What were you seeing that caused you to send us this letter asking for us to change the law?
Senators, I spoke to my team about increasingly targeting Hamas's financial network. What I was seeing was the fact that as we went after their traditional financial resources and banks, that they were going to turn to other means of financing that could frankly even be faster and harder for us to track in cryptocurrency. And yesterday, I had an opportunity to sit down with the families of Americans who are being held hostage by Hamas today. And they asked me, what, if anything, can we do to cut off their finances? And I explained to them the actions we're taking in the traditional financial sector, but told them, frankly, that one of the places where we need additional tools is to be able to make sure that we don't allow Hamas to build up assets in the digital ecosystem using virtual currencies that are hard for us to track, because that is money that they will use to continue to come after not only Israel, but also to destabilize the region.
So how is it right now that Hamas has access to money or some form of financing for themselves?
They are increasingly, in my view, turning to alternative means of financing given what we've done in terms of their ability to do the traditional financial system.
So what does it mean, alternative means of financing?
One of those is cryptocurrency. And cryptocurrency is a means that while we're using every tool we have, we need additional tools to go after.
Okay, and it's not just Hamas and terrorists that are using crypto financing. North Korea, ransomware gangs, drug traffickers, distributors of child sexual abuse materials, name your bad guy, and crypto is the way that they can move money around. Now, your letter that you sent to Congress follows a basic principle. Activities with similar functions and similar risks should follow similar rules. So I want to look at an example of that. I want to look at one of the middlemen examples, validators. So validators are the middlemen between the payor and the receiver, and they help process crypto transactions. In the traditional banking world, if a bank transacts with somebody who's laundering money, then they are breaking the law. But validators in the crypto world don't have that same set of rules. Are there crypto validators right now that are processing transactions for North Korea and pocketing a fee for each of those transactions? Same for Hamas, same for drug lords and child traffickers.
There's reporting that I am familiar with that's public about the fact that those threat actors that you've mentioned are conducting that type of activity.
Okay, so bad guys can use crypto right now because we don't have the right rules to keep them out. But I think it's worse than that. We know, for example, that Iran, one of Hamas's biggest funders, makes millions of dollars validating transactions for others that have no connection to Hamas or Iran. So if I wanted to send $1,000 worth of crypto to you, Mr. Secretary, is it possible that when I just send it, to send this, that Iran could be our validator and would be collecting a fee processing our crypto, all of that without either one of us knowing it?
Senator, a transaction like that is certainly possible.
Okay, so Iran, which is subject to all kinds of sanctions, is moving money through crypto and actually making millions of dollars validating crypto transactions for Americans and for everyone else, all because we don't have the right anti-money laundering rules in place. One more quick question. If the crypto market grows and the number of crypto transactions increases, does that mean more money would likely end up in Iran's pockets?
Everything that we've seen says that when markets grow, threat actors use them more, and we should expect that that is what would happen here as well.
Okay, and more activity, more money. You know, currently the House is working on a bill to create a regulatory framework for stablecoins. Stablecoins make it easier to convert dollars into crypto and crypto into dollars. So they are an on-ramp into the crypto world. If we're going to create new on-ramps, increasing traffic, which is exactly what the House bill does, then we need a regulatory framework that will put the rules for anti-money laundering in place so that we do not have more opportunities for Iran and terrorists and drug lords and human traffickers to make more money. We've got to get those AML rules in place. Thank you, Mr. Secretary.
Senator Vance of Ohio is recognized.
Other folks' time, but I want to get back with you on progress with the tax gap. Thank you.
My colleague, and it's an important issue. The next two in order will be Warren and Blackburn, and I've just got to tell colleagues I've got to keep everybody to 5 minutes at this point. We're just never going to get done. Senator Warren.
Thank you, Mr. Chairman. So it wasn't long ago that the 1-2 punch of the pandemic and nearly 20 years of underfunding brought the IRS to its knees. We all remember the phones that weren't answered, the stacks of unprocessed returns sitting in boxes. But Democrats secured billions of dollars in long-term funding for the IRS so that you could do your jobs. And the turnaround has been truly remarkable. Yesterday was the tax filing deadline, and I want to congratulate you, Commissioner Werfel, and all of the hardworking folks at the IRS for a smooth tax filing system and season. So this year, the IRS launched a pilot program called Direct File, first of its kind option for Americans in 12 states to be able to file their taxes online directly with the IRS. It's easy and it's free. And that means instead of the $150 on average and 9 hours that taxpayers typically spend for the privilege of filing their taxes, they can do it for free with the IRS. So Commissioner Werfel, I'm sure your team is still going through all of the data from the filing season, but what is the feedback that you've seen so far on Direct File?
It's been tremendously positive. The results of the pilot have been super encouraging for a couple different reasons. One, the product worked. Second, our partnership with the states, like Massachusetts, the state's product that we handed it off to, because once you do your federal taxes on Direct File, if you have a state income tax, then you have to do the handshake, like we did with the state of Massachusetts and the state of New York and others. That worked as well. Taxpayers told us in almost unanimity that it was easy to use, fast, secure, and of course free, which was the bottom line that people wanted to emphasize. So very, very encouraging results. But as we sit here, and you know this better than anyone, Massachusetts is still filing, and the pilot isn't done. And I know there's a lot of people that want to know, okay, what was the cost? What are the final numbers?
So we're not there yet.
You're days away.
That's right, days away.
Yeah.
But I do want to start with the fact that Direct File is getting 5-star reviews.
It is.
I take it. So taxpayers are raving. The phrase I've heard is so darn easy that they filed on their lunch break. And best of all, as you say, didn't have to worry about fees, didn't have to worry about ads, didn't have to worry about upsells. You know, the way that giant tax prep companies like TurboTax make their profits. So, of course, these tax prep companies are kicking and screaming and trying to shut the program down. And their lobbyist friends claim that it is somehow illegal for the IRS to provide a 21st century online tax form. this argument is laughable. The IRS, like every other government agency, is supposed to modernize and upgrade services over time. But let's dig in a little more. Commissioner Werfel, decades ago, the IRS mailed out tax filing forms and the post office stocked the paper forms, and that was it. But in 1986, the IRS piloted electronic filing. Back then, that meant plugging in phones into modems, transferring data by tapes. It was real cutting-edge stuff in 1986. To your knowledge, did anyone suggest that the IRS did not have legal authority to do that?
No.
All right. Decades ago, a tax refund was a paper check. But in 1987, the IRS expanded the pilot and added electronic direct deposit to put refunds directly into people's bank accounts. Did anyone, to your knowledge, say that the IRS couldn't do that because direct deposit wasn't specifically referenced in the statute?
No.
And in 2008, the IRS created PDF forms that taxpayers online could fill out and file electronically. Did anyone suggest that service was somehow beyond the reach of the IRS?
No.
You know, there was a time when the only way to ask the IRS a question was to mail them a letter or to show up in person. But at some point, the IRS started using the phone and then email. And whoa, be still my beating heart, the IRS now uses texts. In other words, the IRS is doing what all of government should be doing, modernizing and making it work better for ordinary people. And there is a big return on the investment here. The Economic Security Project studied the full costs and benefits of a full-fledged direct file program and determined that nationwide direct file will save taxpayers $23 billion a year, including tax prep fees that they won't have to pay and tax refunds that people currently miss out on. I did the math. That's about $100 to individual taxpayers for every $1 invested in direct file. It is a great investment. Thank you for the program.
As
Thank you,
much
Mr.
as
Chairman.
I agree with the senator from Massachusetts, we got to move on. Senator
Thank you, Mr. Chairman. So in 1932, Congress created the Federal Home Loan Bank system to tackle the biggest housing crisis of the last century, the Great Depression. And the basic idea was simple. The federal government offered help in the form of an implied government guarantee, favorable regulatory treatment, and special tax status. And then in return, the FHLBs would provide liquidity to their members to support housing and community development. Today, we are in the middle of another housing crisis. By some estimates, we are short 7 million housing units nationwide. But in this critical moment, the FHLBs are missing in action on their affordable housing mission. Last month, the Congressional Budget Office released a report that, for the first time, put a number on how much the FHLBs receive in public subsidies. In fiscal year 2024 alone, that number was a whopping $7.3 billion. Director Thompson, in 2023, how much of these public subsidies did the FHLB spend on affordable housing programs?
I think it was approximately $390 million. I think $350 was
$390 million. So that means the vast majority of the subsidies the federal government poured into the FHLBs went somewhere other than to affordable housing. Only a tiny fraction went to affordable housing. So where did the taxpayer money go? Director Thompson, in that same year, how much did the FHLBs spend on dividends for their members, like banks and insurance companies?
approximately 3.4 trillion.
Billion.
Billion.
Gosh.
I'm sorry, B.
Bad
with a B.
enough.
Sorry.
Okay.
Yeah.
All right. So just so we're clear here, the FHLBs spent 8.5 times as much on dividends to their members than they did on affordable housing. I think that's right. Just the math here. But not all of those federal dollars, those taxpayer dollars, went to dividends. There's still some money left over. According to the GAO, the FHLBs lent tens of billions of dollars to prop up Silicon Valley Bank, Signature Bank, and First Republic Bank before they failed. Director Thompson, FHFA is the primary regulator for the FHLBs. Do you agree that it is important for the FHFA to clarify that the mission of the FHLBs is to provide liquidity for housing and community development, not simply to prop up failing banks and hand out dividends?
Absolutely. Thank you for the question, Senator. We conducted a year-long review of the home loan bank system. We conducted 17 listening sessions around the country, and we heard exactly that the home loan banks they have a dual mission. One is to provide stability and liquidity to their members, but the other is to support the communities that they live in through affordable housing development and community development. And there is a huge affordability issue. There are huge supply issues, and the home loan banks are well positioned to do a lot more. And that's one of our recommendations from our report.
And I appreciate that. Mm-hmm. It's not enough to be well positioned if they are taking the money and then not spending it to accomplish that. So I think clarifying the mission of the FHLBs is an important start. But I think we also need to take a look at who lines up for these federal subsidies. Remember, these government subsidies are to promote housing. But in the last 5 years, 5 full years, 42% of FHLB members did not originate a single mortgage, not one. 42%. So how did this happen? Well, it turns out, under the current rules, members only need to hold at least 10% of their assets in residential mortgage loans at the time they apply to join a FHLB. Once you're in, you're in. And you can get out of the housing finance business while you take advantage of these government subsidies. Director Thompson, should the FHFA change the rules so that members must hold at least 10% of their assets in residential mortgages on an ongoing basis in order to remain eligible for FHLB financing?
That was one of the recommendations in our report. We are going to promulgate rulemaking sometime this year to talk about membership, one, to define what the role is of membership, and to also ask questions about what that threshold should be, because you will have a situation like one of the 3 bank failures where you start out with the 10% to meet the requirement, and then the bank's business model changes, and there's no ongoing checks for them to access the home loan bank system. Yeah. So that is rulemaking. It'll be very transparent, and we're looking forward to engaging in that discussion.
Well, I strongly urge the FHFA to issue its proposed rulemakings to address the FHLB's mission and membership as soon as possible. The FHLB should be tackling our nation's housing crisis, not doling out corporate welfare to these giant banks and to members that aren't even in the housing business. Thank you. Thank you, Mr. Chairman.
Senator Vance of Ohio. Thank you, Senator Hill. Senator Warren of Massachusetts is recognized.
Thank you very much, Mr. Chairman. And if we're going to talk about markets and how perfect markets are, maybe the one thing we should talk about is how concentrated markets have become. And when we have concentrated markets, we have a whole lot less competition. So just a handful of companies have taken over the food industry thanks to literally hundreds of mergers over the last 50 years. Just 4 grocery chains control an average of 72% of sales in American cities. And in most grocery categories like bread, pasta, beef, cereal, just 4 companies control more than 60% of the market. Now, less competition means food brands don't have to compete on either price or product quality. For families' pocketbooks, that means higher prices. Grocery prices have climbed faster than inflation over the past few years. Now families are paying 25% more than they did before the pandemic. So I want to talk today about the tricks and traps that families face when they head to the grocery store. Mr. Bustamante, you have researched corporate pricing practices. I understand that when inflation increases, food producers and grocery stores may need to pass on some of those higher costs to customers. But the question is, have groceries gotten more expensive just because of inflation, that is, passing along higher prices, or is there more going on here?
Thank you, Senator. What we actually see is that if you look at the long-term price, the actual marginal cost of production for many groceries have actually gone down. And part of the big reason for this is actually with just the nature of the supply chains that have actually been developed over time. That being said, those lower marginal costs were not passed on to consumers. Instead, what we see is that for the past 40 years, this just growing and fastening trajectory of markups, basically, again, firms pricing their products and services at a much higher rate than the actual increase in costs. And when we see them during the past few years, that's just been accelerated due to the pandemic.
Right. And something they can do because there's a lot of concentration in the industry, so there's not much competition. In fact, corporate profits rose 5 times faster than inflation between 2020 and 2022. Kraft Heinz, which sells everything from Oreos to pasta sauce to coffee, increased profits by 448% over 2022. Cal-Maine, the largest egg producer in the U.S., increased profits by 718%. In fact, for most of 2023, corporate profits drove over half of inflation. Now, that hasn't stopped Big Food from pulling out another trick. Jacking up prices was not enough, so food companies have decided to quietly shrink the size of products, lobbing off a few inches here, a few chips there, a few cookies somewhere else. This shrinkflation is all about deceiving customers so that corporations can pad their profits. The CEO of the snack company Oots admitted calling shrinkflation the path to higher margins. So it seems like we've lost the basic principle of knowing how much something costs before we pay for it. Mr. Baidoun, you have been studying corporate behavior for years. Have you seen, in your research, have you seen a shift in behavior here?
I have, Senator. Companies deploy a vast array of tactics that really threaten to make the price tag as we know it totally obsolete. I'll just name a few. In addition to shrinkflation, there's also skimpflation. This is the idea of degrading the quality of a product by using inferior ingredients while keeping the price the same or higher. There's also dynamic pricing. This involves changing the price of a product hundreds, thousands, even millions of times in a day or week, making it difficult to predict costs. And finally, there's a practice known as drip pricing. This involves adding on mysterious, confusing fees as consumers are making a purchase, as opposed to building all of those fees into the upfront cost.
Okay, so you've got a lot of tricks and traps you identify. I understand it not only happens when you pull something off the shelf, it also happens when families get to the cash register, when they get ready to check out. Mr. Baidoun, let's say you've picked out all of your groceries, cashier rings them up or you ring them up yourself, and you use your credit card to pay. Can you talk to us a little bit about the opportunities that big credit card companies have to squeeze consumers on their groceries?
Absolutely, Senator. In many ways, customers get gouged once at the checkout line, and in many ways they get gouged again if they carry that balance on a credit card, not only through exorbitant APRs, but also through junk fees like late fees. Up until recently, credit card issuers could charge as high as $41 for missing a payment, but thankfully the Consumer Financial Protection Bureau actually capped those fees at $8, and that's something that'll save 45 million Americans an average of $220 a year, $15 billion annually in total. And so those are the sorts of interventions we need.
And special thanks to the Biden administration that has really started attacking these junk fees. Congress also needs to step up. We need to pass Senator Casey's Shrinkflation Prevention Act to end shrinkflation and my Price Gouging Prevention Act to give the FTC the tools it needs. Thank you, Mr. Chairman.
Thanks, Senator Hagedorn of Massachusetts is recognized.
Thank you, Mr. Chairman. So in 2009, Congress passed the CARD Act to crack down on banks and other credit card issuers that were abusing consumers with excessive late fees and bait and switch terms, like those low initial rates that once somebody signed on the dotted line really jumped up high. The CARD Act slashed average late fees by a third to $23 in 2010. But by 2022, 12 years later, by exploiting loopholes in the law, that number was back up to $32, enough to make the biggest credit card companies an extra $14.5 billion in profits that year. Meanwhile, average credit card APRs have nearly doubled over the last decade, from 13% in 2013 to 23% in 2023. That is the highest on record. Now, as credit card companies have grown their profits through interest and fees, they have also become more concentrated, with the biggest issuers gobbling up the smaller ones. In 2022, the 10 biggest credit card companies in the country accounted for 83% of all credit card loans. Mr. Rust, you have studied the credit card market for years now. Can you say something about how the smaller credit card issuers stack up versus the biggest issuers in terms of how much they're charging consumers, the big guys versus the small guys that are still left?
Thank you for that question. And actually, I was really hoping to have the opportunity to say that CFA and the CFPB have pointed out that interest rates at smaller institutions, small credit unions, are lower, right? And this has to do, I believe, with the fact that the credit card market is somewhat broken, because the way that people are comparison shopping, when they say, I would like to get a credit card, it doesn't take them to the small bank. It takes them through a comparison shopping site, a lead generator that's earning large amounts of fees, to direct them just to the cards that have the highest rates. And we're seeing margin on margin issues where the amount of the margin is growing over time. It's never been higher. And credit card issuers that are larger are charging interest rates that are 8 to 10 percentage points higher now.
Wow. So the big guys with the highest paid CEOs are actually charging consumers a whole lot more than the little guys in the credit card market. And it's the big guys who are hitting particularly hard on customers' pockets. Mr. Suero, you're an expert on predatory lending practices. Who's paying the bulk of the interest and fees that are driving credit card companies' profits?
Yeah, so there's a number of different ways to look at it. CFPB has found that consumers with deep prime, subprime credit scores are paying a disproportionately high amount of fees. We know that that population are generally lower income, working class people of color. We know from our surveys, we know from other consumer surveys, this has been reflected over time repeatedly, that low-income people disproportionately pay these. Latinos, Black consumers also are disproportionately paying these fees.
Okay, so people are paying more, and you know who is paying more, people who are struggling the most. Now, the CFPB is taking action to rein in price gouging in the credit card market, including by capping most late fees at $8. Obviously, very good news for American families. Of course, we know who's not happy about that: big credit card issuers and their Republican friends in Congress. Last month, Republicans introduced a bill to overturn the CFPB's credit card late fee rule so that the credit card industry can continue squeezing every last dime out of these consumers. One House Republican even said, quote, "The vast majority of Americans support these fees." So, Mr. Rust, I have to ask, do you know anyone who is actually a consumer who loves junk fees?
So I have never heard someone say, oh, I paid an overdraft fee and I'm really glad that worked out.
Yeah, that really worked out well for me. I have never seen the bumper sticker, "I heart junk fees," right? How about you, Mr. Suero? Anybody you know who is excited about being gouged by a multi-billion-dollar bank?
No, obviously not. And I want to add two things. One is the CFPB received 57,000 comments from this. A vast majority, or a large number, were from consumers that were saying quite the opposite, that they were fed up with these fees, that they didn't want to pay them, they were very unpopular. The opposite is also true. If you ask consumers, how would you feel about a product that doesn't have such high late fees or low fees? They look at those products very favorably, and they actually have more goodwill towards financial institutions if they were to be offered those products.
Well, I'm really glad that the CFPB is taking up the fight on behalf of consumers and willing to stand up to these big banks. Thank you. Thank you, Mr. Chairman.
Senator.
The concept behind the important work Senator Brown is doing. He is talking about workers who have been laid off through no fault of their own. That's who we're talking about here. And he is coming up with ideas to get those folks back in the winner's circle. And he is pointing out that a lot of the programs, as he calls it, is essentially losing insurance. You know, you've lost, things are bad, everybody's hanging crepe. And Senator Brown is saying, no, that's not the way we're going to go. We're going to talk about programs that get workers back in the winner's circle, and I'm proud to work with them. Okay. I believe Senator Warren is next, but then Senator Blackburn would be next if nobody comes in. Senator Warren.
Thank you, Mr. Chairman, and thank you, Senator Brown, for your leadership on these trade issues. It's so important to working people all across our country, and I completely support what you're doing here. You know, for too long, our trade policy has been a global race to the bottom. Corporate lobbyists and trade negotiators worked in back rooms to ink deals that lowered labor and environmental standards and made it easier to offshore jobs. American workers have had enough. And finally, some politicians in Washington are starting to listen to those workers, but not everyone. House Republicans just advanced a bill to extend the Generalized System of Preferences, or GSP, a program that lowered U.S. tariffs on goods imported from certain countries without requiring those countries to cut tariffs on our exports as well. And those same Republicans oppose renewing the Trade Adjustment Assistance Program, or TAA, that Senator Brown was talking about, which helps American workers get back on their feet when they lose their jobs due to trade. So I also would like to talk about TAA and other policy tools that we have to protect U.S. competitiveness and workers. So let's just start with a little Econ 101. Ms. Gill, you're the legal director of Global Labor Justice. So tell me, when the U.S. cuts tariffs and imports more goods from abroad, is it just a win-win for Americans?
Thank you, Senator. No, I think it's really clear that even with very careful tailoring of programs, gains from trade are not always equally distributed, and some workers do lose out.
Okay, so we have workers losing out when that happens. And this is basic economics that even free traders have to admit to. Some people lose from trade. So what are we going to do about that? Number one, we need to protect our workers from unfair trade. And that's why President Biden is raising tariffs on massively subsidized Chinese imports, like cars and computer chips and steel and aluminum, that undercut American workers. Number two, we need to invest in American competitiveness, like we have with our domestic semiconductor industry and clean energy manufacturing. But even with all that, some workers will lose their jobs due to trade, and that is where TAA comes in, helping those workers find new jobs. Ms. Gill, what does TAA mean for the workers who receive it?
As I noted in my remarks, we believe that labor justice begins here at home. We stand with the U.S. labor movement to call for TAA together with a renewal of GSP. TAA provides resources for retraining workers who have lost their jobs due to trade. It provides sort of extended unemployment insurance. And some analysis of the program shows that about 10 years out, workers who've received a helping hand from TAA have earned $50,000 more than workers who haven't received the assistance.
Okay, so people get training, and as a result of the training, they're actually able to get good paying jobs. And they're earning, I think you said, about $50,000 more a year 10 years out because they got some assistance after they lost their jobs. Since TAA lapsed in mid-2022, over 100,000 workers have lost their jobs due to trade, but have been unable to get these TAA benefits. Meanwhile, House Republicans advanced legislation renewing GSP, which would retroactively cut U.S. tariffs already among the lowest in the world. Under this Republican bill, large businesses and importers who decided it was worth paying a tariff to import goods from overseas as far back as 3 years ago would get a windfall refund of $2.6 billion. By the way, that is 5 times the cost of TAA. Ms. Gill, I know there's a lot of work that we can do to update GSP to raise labor and environmental standards in the countries that benefit from it. But wouldn't you agree that if we're going to renew a tariff cut program like GSP, we should also renew TAA?
Simply put, yes.
Yes, I like that answer. Exactly right. You know, thank you. I appreciate this. American workers are sick and tired of the race to the bottom in trade and the slashing of investments in our domestic economy. And I'm glad that under President Biden's leadership, we're turning things around. Since he came into office, the United States has added 80,000 new manufacturing jobs. But there is still so much more to do. Over 100,000 American workers across the country are waiting for Congress to renew TAA and to help them get back on their feet. We owe it to them. Let's get this done. Thank you, Mr. Chairman.
I was thinking about a modest filibuster in hopes that some of our other colleagues, but we've got very...
Thank you, Mr. Chairman. So in 1972, Congress established the Social Security Income, or SSI, so that people with disabilities could live in dignity and be somewhat self-supporting by getting a monthly cash payment. And it's now a critical lifeline for about 8 million Americans. But the problem is that these outdated rules have stranded about 4 out of every 10 people who receive it in poverty and unable to work. So I want to walk through an example just to make sure we're in on the numbers. A young woman living with disability who receives the average SSI payment, which is about $698 a month last year, well below the poverty line. So she picks up a remote minimum wage graphic design job for 8 hours a week, allowing her to take home another $232 a month, still leaving her well below the poverty line. Ms. Wilschke, you're an associate commissioner at the Social Security Administration. Say that SSA sees that this woman is earning $232 from her job each month on top of her SSI benefits. Under current law, can she keep the $232?
Thank you for the question. She would keep part of it, but it would be, her benefit would be reduced.
How much?
It's 80, she can keep the first $85 and half of the rest.
So she gets $85 is the amount she can keep from her work. And after that, for every $2 she earns, what happens to her Social Security benefits?
It would go down by $1.
They go down by $1. You know, and then it gets worse. We've talked about another part of this, Cliff. Say she works for a few hours each week. She manages to put a little money aside. She wants to put down a deposit to try to get an apartment. And between her savings and SSI and her job, she manages to save just a little over $2,000. Now, when SSA sees that she has over $2,000, just walk us through. What happens, Ms. Wilschke?
Generally speaking, if she has liquid resources above the asset limit, she would not be eligible, at least for that month.
So she loses all of her benefits at that point. So she's done at that point.
Yes.
So SSI rules mean that this young woman can't afford to save for an apartment. She can't take a part-time job without jeopardizing her benefits. And having to continuously toe the monetary line here in order to keep her existing payments, I think is a minefield, as Senator Whitehouse has just pointed out, especially for an individual with a disability. So it's not just hard for SSI recipients, which we've been talking about. I want to talk about what it does for SSA. Associate Commissioner Wilschke, how does the complexity of SSI's eligibility rules impact the Social Security Administration and your administrative costs?
Thank you for the question. Yes, SSI is complex for us to administer, and so while SSI payments only make up about 4 or 5% of our benefit outlays, it does make up about a third of our administrative budget.
So you're spending a third of your budget to track down people who now have $2,010 in total assets or who have made $100 more than the $85 that they were entitled to earn without triggering this. You know, SSI is supposed to keep Americans with disabilities out of poverty, but it offers below poverty level support. It punishes people for working, and it punishes recipients for savings, all while the Social Security Administration is spending big dollars in order to administer this system. So I think we've all been talking about the importance of making changes here. I'm working with Senator Brown and others on this committee to pass the SSI Restoration Act, which would raise the benefit rate and help fix these outdated rules. I'm glad to see that there's bipartisan support for raising the asset limits so that SSI beneficiaries can save more than a few pennies without fear of losing their benefits, and so that the Social Security Administration can just spend less time administering all of this. Thank you, Mr. Chairman.
Massachusetts is recognized.
Thank you, Mr. Chairman. When the CEOs of giant banks can boost their bonuses by getting the banks to take on more risk, they run the risk that they will end up running their banks into the ground. It happened in 2008 and it happened again in 2023. Back in 2010, though, Congress passed the Dodd-Frank Act. Section 956 told financial regulators, solve this problem. 2 months ago, regulators put forward a proposal, but the Fed refused to join. Now, in 2018, you told this committee, Mr. Chairman, that you, quote, expect that banks will have in place compensation plans that do not provide incentives for excessive risk-taking. In other words, you trusted the banks to write their own rules. So let's see if they actually have. One thing the proposal would do is require big banks to delay bonuses for a broad group of critical employees who are able to gamble with the bank's finances, like the head of a trading desk, for example. Chair Powell, in the 6.5 years since you said trust the banks to regulate themselves, how many of the 10 biggest banks have put policies in place to delay annual bonuses for this broader group of critical employees whose risk-taking could endanger the bank?
I don't know specifically. My guess is all of them. Since the financial crisis.
You're the regulator who said trust the banks to self-regulate so we can avoid another financial meltdown or another bailout. And you don't know if they did or didn't do that?
Well, it's a very, very specific, narrow question you're asking about.
Because it's something a regulator should do. You think the answer is 10 out of 10? The answer is 0 out of 10.
Yeah, I doubt that.
Well, go back and look, because we've looked at their statements on this. Another thing the proposed rule would do is require the banks to consider flat-out banning bonuses and bonus pay for executives who took risks that threatened the stability of the bank. So let me ask you this one, Chair Powell, in the 6.5 years since you said trust the banks to regulate themselves, how many of the 10 biggest banks now have policies that would require them to flat out deny bonuses to executives that have engaged in inappropriate risk-taking?
I don't know the answer to that. By the way, I never said trust the banks to regulate themselves.
I'm sorry, do you want me to go back and quote you again exactly?
Trust the banks to regulate themselves?
When you say, I expect that the banks will have in place compensation plans that do not provide incentives for excessive risk-taking.
Right, pursuant to the guidance that we issued in 2010, which is quite detailed.
And you have not issued a guidance since you made these comments, since you became chair. And how many banks have actually put in place the regulations that you said, I expect the banks will have in place? The answer is out of 10?
It was covered by the
Zero.
2010 guidance, actually.
No, you said in 2018 that they would put these in place.
I said they would have in place.
No, that is not what you said. So look, Chair Powell, the last guidance on this subject, as you say, was in 2010, which is before you were at the Fed. The Fed has now refused to join the other financial regulators in finalizing a rule implementing Section 956 as Congress directed. So my question has been, how many of the 10 biggest banks have done this? And the answer is 0. Dodd-Frank was passed 14 years ago. There are still no rules to stop banks from rewarding executives' risky behavior. When you were asked about these Section 956 rules or lack of rules in March of this year, you said, quote, that you wanted to understand the problem we're solving before proposing a rule. Chair Powell, the law does not say Jerome Powell, in his infinite wisdom, should decide if we have a problem with executive compensation. The law passed 14 years ago says executive pay is a problem that threatens the stability of our economy, so write the rules to rein them in. Finally, the other financial regulators have proposed such a rule, but the Fed has not joined. Chair Powell, I understand why the 10 biggest banks in the country like your approach. You let them do whatever they want, but you don't work for the giant banks, you work for the American people. I urge you to do your job. Thank you, Mr. Chairman. About Dr. Sherholtz, since I tend to think you are driven by data, and that's what's important here, are trapped in non-compete agreements. Corporations use non-compete agreements to hold workers hostage. It prevents them from either starting a competing business or going to work for another employer. So a worker who has a non-compete faces two bad options: stay stuck in a job that you really want to leave, or upend your life to break free from the non-compete by moving away from your current job, changing your career, leaving the workforce, or risking an expensive years-long battle in court. I believe that workers should have the freedom to switch jobs. They should be able to seek higher wages, better working conditions, and if they so choose, to start their own businesses. But big businesses want to control workers and stifle competition, even if it hurts our economy as a whole. Dr. Toussaint, if you had to sign a non-compete agreement when your medical practice was bought by a private equity company, and can you just say a little more? You talked about this a bit in your opening statement, but how broad this was. This was not a non-compete that said you can't go right next door and open the same practice under almost the same name. How broad was your non-compete? What all did it cover?
Thank you for the question. It's important to note that the private equity group at the time was located in 3 states, Colorado, Arizona, and Florida. My non-compete specifically said that I would be restricted from practicing orthopedic surgery within 25 miles of any facility in which they are doing business, any facility that they had previously done any business, any facility that they are currently targeting for expansion within the entire state that I am currently living in, which is Florida, and then any facility that they have had discussions with in thinking of acquiring in the future. And this would be valid for approximately 2 years. So we're talking 3 states, and in my specific location, at the time I was one of 2 surgeons covering specialized treatment for over 850,000 people, most of which are within rural counties. Okay. I thought that was insane.
All right. So they have barred you basically from practicing medicine in any of these 3 states. And I detect from the way they wrote it, in case they were thinking about any other states, you would also be covered in those. But I take it was more than just a prohibition on going into private practice. When you were offered a job at a publicly funded academic hospital, what happened? Can you say again about what happened when you tried to accept that job?
Right. Unfortunately, as part of their agreement, they wanted me to give a copy of the employment agreement and non-compete clause to every employer that I was having a discussion with. So that's essentially like a scarlet letter or basically a mark against me to say that if you want to hire this doctor, despite his specialized training, you're going to have to go through us. And we are in multiple areas across the United States.
Right. And so now let's talk about what go through us turned out to mean. In fact, you were able to go become a teacher of other doctors, which is obviously not a direct competition originally. So calling this a non-compete, it shows how much it is stretched out in terms of how much it restricts you from doing. But what was the consequence of the you have to go through us part of this contract? How did you ultimately end up going to work for the university?
Thankfully, the university and the community needed me more than they wanted me out of town. I unfortunately had to engage a number of community leaders, including the NAACP, and a lot of my patients to go and support me in this effort to be able to work. If I didn't do that, I would have to relocate out of the state, and I would have missed out on a number of collaborations within the university.
You know, I just want to say, we talk about what happens to an employee who's stuck in one of these non-competes, but you have given us a perfect example of how those non-competes end up hurting communities, in your case, end up hurting patients, others that you serve. And in this case, I just want to underscore, communities are served now by the more than 37% of physicians across this country who are currently bound by non-competes. So unless you go through the person who owns that contract, these are whole communities that could lose access to the physicians that have served them so well. So you had folks on your side who were able to weigh in so that you ultimately were able to go to the university. Ms. Page, let me turn to you. Your former employer used a non-compete to keep you from designing wedding dresses, whether it was under your name or some other name. Can you just say something about what that meant both for you and for your brides?
Thank you for your question, Senator Warren. It was devastating and disheartening. I am in an industry that relies on an emotional purchase, and there is an authentic connection made when saying yes to the dress. And to have that tarnished or severed is almost as if we're putting a veil over what's really happening. And in my experience, it was truly difficult to imagine how you could communicate and make that connection to a bride if not only I couldn't express myself creatively in the way that I thought I could, but I couldn't even use my name or practice the trade. Mm-hmm. It was interesting, I think, too, from the business perspective, because we are a wholesale business and all of these stores had invested specifically in a designer collection. And so when the designer was no longer behind the dresses, they were affected. They felt the residual stress of, how do I explain to the consumer and the brides coming in the doors that this dress no longer has the Haley Page behind it? Mm-hmm. And obviously, when you invest that kind of money in your business and you're unable to sell the merchandise or feel ethically icky in doing so, it creates a really big void in the marketplace.
Right. So hard on patients, hard on brides, hard on the other small businesses that have built up around you and your brand, wanting to sell those Haley Page gowns. Can you just say one more word about it, though? I thought about when I first heard about your story, what it must feel like if you're a pianist and you're not allowed to play the piano, if you're a painter and you're not allowed to paint, if you're a wedding gown designer and you have been told you cannot make wedding gowns. There are other things you can do in life, but that has been crossed off your list for years. Can you just say a little bit about how that feels?
Yes, thank you for your question, Senator Warren. It was soul crushing, but what's interesting about my case is that it was challenging my identity from 3 different factors. I was unable to use my birth name, I was severed connection to my social media community, and I was withheld from my trade. Of all 3 of those things that are extremely hard to wrestle with and digest, not being able to practice my trade was the most emotional and hard to overcome. And in that moment, I had realized how much of my identity came from my craft. And I think when you devote yourself to a craft, part of you becomes that craft. And it really did feel like a severing of who I was. And I'm so grateful, of course, for the support I received. But it was also particularly devastating to feel the confidence and the height I was at in my career. Not very many people can perform at that level. And that is something that should be celebrated. And as a woman who struggles with insecurity, to feel like you're really good at something, but you're not allowed to do it. And then you have these amazing women that want to see you do it, but then you can't deliver. It's emotional and devastating.
So, Dr. Sherholtz, you've just heard from 2 people who have lived through experiences with non-competes. Each of them have fought back, and they have mustered communities around them and been able to hit back. But talk just a little bit about the effect of these non-competes across our economy.
Yep. Yeah, the things that Ms. Page and Dr. Toussaint experienced, they're just all too common. Non-competes restrict workers' ability for starting a business, for practicing their craft in their community, for taking another job in their community. And economy-wide, when you put the data to it, what you find is that reduces business formation, it reduces worker mobility, and then those things reduce productivity, they reduce innovation, they increase prices, and they reduce workers' wages. So we can see how this played out in these folks' lives. And then when you look more broadly at the economy, it's just incredibly harmful on all measures.
Well, I'm very grateful to you two for telling your stories, and very grateful to you, Dr. Sherholtz, for just describing and putting the context all across our economy. The Biden-Harris administration has taken historic action to ban non-compete agreements. And right now, it is fighting back against the Chamber of Commerce and these giant corporations that continue every day to profit off non-compete agreements. Now, one of the things I want us to turn to now, I'm just going to give myself a second round of questions here since I don't have anyone competing with me for this time. I want to talk about what the Biden-Harris administration is doing here and how it is a game changer to ban non-competes. By giving workers the freedom to move jobs and to start new businesses, employers are going to have to change what they do. They're going to actually have to compete for workers. Workers' earnings, we believe, will increase collectively by about $400 billion over the next decade, according to the FTC. A typical worker, it would be about $500 more that worker could take on. And the American economy will be more dynamic and innovative, with about 8,500 more new businesses and tens of thousands more new patents if people can get out of these non-competes and go out and either start their own businesses or go into business with someone else or work for someone else. We get this massive economic boom because the FTC has designed the ban to be extremely simple. It says no new non-competes at all. It's not fussy, it's not fancy, none. Existing non-competes can be enforced only for the most senior executives. So good for workers, good for the economy, but big corporations are unhappy about this rule. So what they say is they could do a rule, but they want a rule that is narrower and more complex. More like Senator Kennedy was talking about on, well, maybe a case here, maybe a case there, but a lot of very complex rules about how to make that work. Dr. Toussaint, you struggled with a non-compete agreement in Florida where you live, but Florida already has a law that says a doctor cannot be bound by a non-compete if in their county all the doctors in their specialty work for the same employer. So I can't think of a law more specifically designed to address your specific issue. Why didn't that law just permit you to get out of your non-compete without any further question?
Thank you for the question. Number one, it's important to realize that this private equity company was not based in Florida, and their tactic is to file suit outside of their jurisdiction and outside of my own jurisdiction. So the plan is to wage a suit away from where we both live and make it as long and as expensive as possible, to the extent that I would give up and I would walk away before a judgment is even rendered. And so a scenario like that, you could imagine that the doctor's resources would not be as sufficient as the private equity firm's resources, and they could run it dry. Even though eventually I might win, it's unclear if I would even last that long.
So part of the problem we've got here then is the litigation itself is expensive, and they have found ways to make it even more expensive. I take it, Ms. Page, that was what you ran into?
Precisely.
Yeah, just drive up the costs and grind you down into the dirt. So the threat of the non-compete is big and important. It's also a question of who's going to be on your side to fight this. Who had to pay your legal bills, Ms. Page? Who was there?
Unfortunately, I tapped out.
Yeah, it's you, right?
Yes.
And Dr. Toussaint?
Same here.
You had to bear your own legal bills. So what the FTC has said is we're going to have a very simple rule. It's going to be a nationwide rule. You don't get to go sue in some other state and think you can avoid some local rule. But it's also the case that the FTC can enforce it as an unfair practice, which means instead of being out there all by yourself, you will actually have someone on your side. That's the idea behind this. Yes, I see you smiling, Dr. Toussaint. That sounds like a good thing. You know, I want to point out one more thing before we leave this, and that is that the FTC's non-compete ban is very popular. Polls show that an overwhelming proportion of Americans and a majority of small business owners support the FTC's rule. In fact, as you know, when the FTC is about to put a rule in place, it's still a proposed rule, they invite public comment. They got 25,000 comments on the non-compete rule. And I just want to say, not everybody sits around in the evening and says, what can we do tonight? I know, let's go do a non-compete rule comment on the FTC website. Of those 25,000 comments, 24,000 came from individuals and businesses who said, we want to have meaningful non-compete clauses. This is valuable to us. And many, many people went on the FTC website to tell their own stories, very much like yours, Ms. Page, very much like yours, Dr. Toussaint, to talk about just how challenging it was when they got hit with a non-compete and how many people just gave up. They did not have the money for lawyers. They simply could not go forward, so they stayed in really horrible jobs. At this point, I'm going to pause and see if Senator Van Hollen would like to ask some questions. Would you like to do that? Good.
Senator Warren.
Thank you, Mr. Chairman. I appreciate your holding this long overdue hearing. You know, there's no better investment in our future than an investment in childcare to help mamas and daddies get to work and to give our babies a strong start. Right now, the U.S. ranks 33rd out of the 37 richest nations on earth in child care investments. And a major reason is because every year, Congress decides how much child care funding to appropriate. And every year, it is a fight with anti-government extremists who want to cut programs that help American families while cutting taxes for rich people. Meanwhile, there's a program in this committee's jurisdiction called the Child Care Entitlement to States, or CCES, that provides some permanent funding outside the appropriations process that families can actually rely on. It is not nearly enough, which is why Chairman Wyden and I introduced our Building Child Care for a Better Future Act to expand CCES and make long-term investments in child care. Now, Dr. Pratt, you're an expert in early education and child care shortages. Why is the child care market so broken?
Thank you, Senator Warren. The child care system is primarily funded by parents. Parents shoulder the burden of funding the system. There is government funding, but states, including Oregon, have contributed quite a bit to bolster the federal spending, and it's just not enough. So there's not enough supply, and families are really struggling to find it.
Okay, so bottom line, we need more supply. But providers and their staff are living paycheck to paycheck, barely able to keep their doors open, much less add more slots and lower the fees that they charge to the families in their communities. An insurance premium increase, a rent hike, a few families pulling their kids out, any of these can push a provider over the edge and out of business. So, Dr. Pratt, for that provider who's operating on the razor's edge, what impact does reliable long-term government funding have in terms of the investments that the child care provider can make and the services they can provide?
It allows providers to plan ahead. It allows providers to think beyond the paycheck to paycheck on their end and month to month, to even consider increasing wages, to expand slots, perhaps reopen care for infants and toddlers that they may have had to close because it was too expensive.
Okay, all right, so they can make better investments and more investments. Now, while other nations have invested in universal child care, what did the United States do? We cut taxes for the wealthy and the well-connected. The $2 trillion 2017 Republican tax cuts were just the latest giveaway, and now lobbyists are drooling over the possibility of trillions more in tax cuts next year when a big chunk of the 2017 laws expire. Ms. Goss-Graves, you're the president and CEO of the National Women's Law Center. You know a thing or two about smart investments in American families. As the Finance Committee considers where to put federal dollars, does it make sense to give more tax breaks to billionaires and billion-dollar corporations, or to invest in childcare?
I don't think billionaires need more tax cuts, but families definitely need more child care. And in fact, having more child care available and accessible, that will help businesses for sure.
Yeah. So when we think about just our economy overall, not just mamas and daddies, but everybody in our economy, we do better when we invest in our children. You know, in fact, research shows that for every $1 we invest in child care, we get $12 back by keeping parents in the workforce and jump-starting the education of our workers of the future. And that is why I am working with Chairman Wyden and other committee members to make long-term investments in child care supply, from boosting child care worker pay to supporting professional development with apprenticeships and in partnerships with unions. The choice before this committee is clear. Are we going to be a nation that invests in our future and supports parents trying to find good, affordable care for their children and invests in the people who do the work of caring for our children? Or are we going to be a nation that just keeps throwing tax breaks at billionaires? I think families are counting on us, and that's where we need to make our investments. Thank you, Mr. Chairman.
Thank you, Senator Warren. Senator Warren, touched on the area I began with as
Tell Senator Warren from Massachusetts.
Thank you, Mr. Chairman, and congratulations to all of our nominees. Good to see you here today. So, Commissioner Goldsmith-Romero, as chair of the FDIC, your job would involve not only helping to prevent bank crises, but also cleaning up after them when the banks fail. You've had decades of experience as a financial regulator, including getting up close and personal with teetering banks during your 10 years as head of SIGTARP. In the fallout from the 2008 financial crisis, Congress created a $700 billion fund called the Troubled Asset Relief Fund, Program, or TARP. It was designed to stabilize the financial system, and you led the oversight of that huge fund for a decade. You also managed SIGTARP's $45 million operating budget and its hundreds of staff. By all accounts, you did so with incredible success, recovering over $11 billion for the American people. In fact, I understand that for every dollar your office spent, the American taxpayer got a $29 return. That's pretty good. Commissioner Goldsmith-Romero, your work at SIGTARP required you to review the quality of bank assets, confidential examination reports, management processes, and compliance with federal regulations. So how does that compare with the kind of work a bank examiner does at the OCC, the FDIC, or the Federal Reserve?
It's very, very, very similar, Senator. I appreciate that question. So we would go in just like a bank examiner goes in. In fact, sometimes we'd grab the operating system and go through the banks. We'd look at what led up to the call reports. We'd trend out the call reports. We'd see changes in CAMEL's ratings. I mean, we would go deep into these banks. I think the difference is that we had more time to look at these. We dealt with a lot of failed banks, troubled banks. We would determine the cause of the failure. And then when we would determine the cause of the failure, if we could hold some bankers accountable for that, we would seek reimbursement to the FDIC for losses to the Deposit Insurance Fund. That's harder for bank examiners to do this. And then we had a higher standard that we had to prove in doing our work.
All right, and that's where your $29 to $1 invested came from, holding these folks accountable.
Yeah, this is how we got our great return on investment.
Good. That seems like pretty useful experience for the person named to lead the agency in charge of dealing with failed banks. In fact, I can't think of better experience. The last Republican who was named to head the FDIC had no experience in dealing with failed banks. Ms. Goldsmith-Romero, you ran SIGTARP at a time of extraordinary upheaval in the banking industry. Can you estimate how many troubled banks you dealt with?
Hundreds. I mean, there were more than 700 banks in TARP. We were constantly working with them, trying to understand their health and their condition and risk that they faced. And then we investigated and went very deep into triple digits.
Okay. So you spent years digging through the guts of troubled banks and compliance with banking and securities laws. You kept some open, others you ended up closing, and that experience is pretty much spot on for somebody to lead the agency in charge of monitoring the banks and cleaning up the ones that fail. Commissioner Goldsmith-Romero, we know that there are workplace issues at the FDIC. During your time at SIGTARP, there were some workplace complaints filed. Should that be a red flag that you are not a successful manager?
No, Senator. You want to have a process that people feel safe using and that they actually do use and they're not fearful of. And that does not exist at the FDIC. But you also want to look at the results. And in 11 years, we only had one finding against us early in my tenure, and I took it seriously and addressed it. So ultimately what you want is to set up an environment of high dignity, professionalism, respect. Employees feel supported and valued so that they'll come in and they'll give 110%. And that's how we got such great results at SIGTARP.
Yeah, well, I very much appreciate both that you have thought through these issues and actually have extensive experience with it. These are critically important economic positions that the nominees before us are eminently qualified to fill. I'm sorry I don't have time to talk with everyone, but I really appreciate your work here. Thank you, Mr. Chairman.
Thank you. Warren from Massachusetts is recognized.
Thank you, Mr. Chairman. So the Committee on Foreign Investment in the United States, or CFIUS, reviews foreign investments in our country to make sure they don't pose a risk to national security. Increasingly, foreign companies are building crypto mining facilities on U.S. soil. These mines are actually warehouses stuffed with computers that process crypto transactions and produce new crypto tokens. They're loud, they're hot, and they suck up a ton of electricity, which can crash the power grid. And that's why many countries have banned crypto mining, leading more foreign companies to set up shop here in the United States. According to a blockchain analytics firm, today 1/3 of crypto mining facilities in the U.S. are owned by citizens of the People's Republic of China, including people with direct ties to the Chinese government. Now, crypto mining is a disaster for the environment, and it can pose national security risks as well. In May, at CFIUS's recommendation, President Biden issued an order requiring the Chinese national owners of a crypto mining facility in Wyoming called Mine One to divest their ownership and remove the crypto mining equipment from the premises. Assistant Secretary Rosen, you're the head of CFIUS, so you oversaw the investigation into Mine One and told the president that the divestment was essential. The divestment order cited two primary factors. One, the technology inside Mine One could be used for surveillance. And two, Mine One was located 1 mile from a strategic missile base housing intercontinental ballistic missiles. So I want to ask you, could the equipment inside that crypto mine have been used to spy on our military operations and our nuclear weapons system?
Senator, thank you for the question, and I think pointing out this case in particular, I'm limited in terms of what I can say about this particular transaction, but to answer your question, there is a generalized concern that sophisticated equipment in proximity to sensitive facilities can be used for espionage.
Okay, so can be used for espionage. Foreign adversaries are using crypto mines to spy on U.S. military operations. That's an obvious national security risk, but it isn't the only risk. Foreign-owned crypto mines also threaten our energy grid. According to an analysis by the New York Times, Bitcoin mines in the U.S. owned by Chinese nationals use enough energy to power 1.5 million homes. National security experts have warned that foreign-owned crypto mining facilities' connection to our energy grid could leave the U.S. vulnerable to targeted blackouts and cyber attacks. Assistant Secretary Rosen, if China or another foreign country had the power to crash a significant portion of our country's power infrastructure, could that threaten our national security?
Senator, of course, an impact on our energy sector, our energy resources, our energy supply chain could very much have a national security impact.
All right. There is yet another risk as well. Foreign nationals have been able to buy up crypto mines in the United States in secret. How? By paying in crypto. Crypto allows them to bypass our traditional banking system and the anti-money laundering rules that are supposed to prevent any anonymous foreign money from coming into the U.S. In fact, that is exactly how a Chinese investor was able to secretly buy a $6 million crypto mine in Texas. It is also how U.S.-based crypto mines have been able to secretly send millions of dollars back to China. Assistant Secretary Rosen, Do you agree that we need to plug the holes in our anti-money laundering rules that have allowed foreign nationals to secretly buy U.S. crypto mining facilities or make other kinds of investments in the U.S. without our knowing about it?
Senator, I certainly share your concern about ultimate beneficial ownership and making sure that we know who is doing the buying. I can speak for the CFIUS context. When we look at a transaction or try to find a transaction, that's a critical component to our diligence.
All right. Crypto mines could be used by our adversaries to spy on our military bases or to bring down our power grid or to move money in and out of the country in secret. Last year, the Treasury Department requested additional tools from Congress to prevent China, Iran, Russia, and other foreign countries from using crypto to evade sanctions and launder dirty money. It is time for us to pass the laws that Treasury needs. Thank you, Mr. Chairman.
Thank you, Senator Warren.
The hearing.
You bet. Thank you, Senator Van Hollen. Appreciate your coming by and asking these questions. So I just have one last question I want to take a look at. You listen to stories like Dr. Toussaint and Ms. Page, and you see it just seems so obvious that we should ban these and that we should not ask people to litigate them on, even when they've got a rule that looks like it applies to them. Let's just get rid of them overall. But right now, what we've got is a lawsuit, Jenning, in the Chamber of Commerce, and a handful of giant corporations are trying to sue the FTC to prohibit them from going forward with this ban. So, Dr. Sherholtz, we've talked about whether or not there's really any legal basis for it. I think that the authorizing statute for the FTC makes pretty clear that the FTC can do this, but the Chamber of Commerce and these big corporations have done a little judge shopping, and they've gone down to this Trump appointee judge down in Texas and are trying to fight this. So my question to you is, why is the Chamber of Commerce, why are these big corporations spending so much money to try to block the ban on non-compete clauses?
It's because of who they represent. They represent business owners and often very big business owners, and those are the ones who actually benefit from non-competes. They benefit because they can protect their position by keeping other people from being able to form business who then compete with them. They benefit because they can pay their workers less and prevent other businesses from being able to hire away their workers by offering them better jobs. So they are actually much better off with non-competes. And so it's totally reasonable why these business groups are fighting tooth and nail to keep their non-competes, but that does not mean that they're good for the economy, does not mean they're good for the country. They are not. They are bad for the vast majority.
Right. I think your point is a really strong point. It's not only that they want to be able to treat their workers however they want to treat their workers, and all the worker can do is just say, okay, I won't work at all. That obviously is not a solution. But that it's also a way for these giant businesses to make sure they don't have any competition. That the Haley Page wedding designs are not out there competing with whatever business they want to have in the wedding space. That Dr. Toussaint is not working with other doctors to provide alternative medical practice and an alternative approach to it. That the private equity group that set this up wants to continue to reap all the profits of a non-competitive market, and that's a key part of what's going on here. I just want to say again how much I appreciate your bringing this forward and telling these stories so that people who may not have ever had a non-compete clause, or worse yet, may actually be subject to a non-compete clause but will not discover it until the day comes that they want to go work somewhere else, or they want to start their own business, or they've got some terrific idea and want to link up with a couple of partners and go build something new and discover that they're not able to do that. I so appreciate what the FTC and the Biden-Harris administration is doing to just level the playing field, to say that anyone who goes to work can go to work. We can have all the rules we need about not disclosing confidential information or taking someone else's intellectual property. But as for your own labor and how you want to work and what you want to do, that's open. And you can take that labor where you want to go and build what you want to build. That is the American way. So thank you very much for being here. I'm grateful to you for coming to this hearing. Questions for the record are due 1 week from today. That's Tuesday, August 6th. For our witnesses, if there are additional questions, you will have 45 days to respond to any of those questions. And with that, this hearing is adjourned.
Senator Warren.
Thank you very much. And thank you for holding this hearing today. And thank you all for being here. So I want to ask about someone later in life, maybe someone whose spouse passed away a few years ago, who's, recently started spending more time online, maybe a dating app. They try to meet someone. They talk about food. They talk about work, family, friends. It just feels good to have someone to be able to interact with. And for weeks, maybe even months, the subject of money never comes up. And then one day, the new online friend reveals how much money they have just made in this amazing investment. Now, our senior, very suspicious, not easily tricked, quite reasonable person. They don't send a dime to the online acquaintance. In fact, to reassure our senior, the online acquaintance says, you should set up your own trading account and load your money directly into it. I certainly wouldn't want any access to that. And the online acquaintance says, all I'll do is just give you some tips on good times to invest and the kind of investments you want to make. That seems so safe to someone. So, Ms. Nofziger, you lead the AARP's victim support team. Does this story sound familiar to you?
Yes, we hear this every day. This sounds like a romance scam / cryptocurrency scam.
And this scam, I assume, starts small. Maybe the scammer starts out saying invest $100. So the senior sets up the account, deposits $100. And from what it looks like on the website, within a day, there's $200 in the account. Absolutely doubled their money in a day. So they load another $200 in and then $400 in, and it just keeps growing. Now they've got $1,000 in this account, even though they've only put $400 into it. Then they get the message from the online friend. This is the moment. This is the moment to go big. The investment is about to go through the roof. So our senior withdraws money from their retirement account, puts it in this great new investment, and over a few months' time, our senior has now invested $300,000 on this website, and it shows them that the $300,000 has ballooned to $3 million. Of course, the senior doesn't know it yet, but the dashboard is entirely fake. There is no $3 million. And of course, the $300,000 has completely disappeared. So, Ms. Dossiger, when do the victims discover that they have been defrauded?
It depends. I mean, sometimes they'll try to withdraw that money and they'll say, oh no, you have to pay another $5,000, penalty fee or taxes. And so the victim thinks, oh, well, it's another $5,000 at this point. I already have $3 million, why not? So they'll put that in. And then that's when the doubt starts to seep in. But unfortunately, we have heard on the helpline that people don't realize it until every single penny is gone.
Right. And this is why I think it's so important to underscore this. I'm all for being able to get your money back in 48 hours, recognizing that's better than no time at all. But we're talking about the money has disappeared weeks earlier, sometimes maybe even months earlier. And the story I have told is not just a hypothetical. This is based on countless true stories, including one specifically from a victim in Massachusetts. According to the FBI, Massachusetts residents lost $85 million to romance or fake investment scams last year alone. In the last 4 years, consumers around the globe are estimated to have lost $75 billion. So, Ms. Nofziger, Once the crime has been reported, is law enforcement able to get the money back for victims?
We certainly encourage every victim to report to law enforcement, but law enforcement tells me it's very difficult to claw that money back because usually it is sent on a digital currency platform and it's also sent overseas. And as you said, oftentimes it's not reported in a timely manner, but we still always encourage to report.
So what more can the federal government do here?
Thank you. I think there's better coordination, better data sharing, and I think there's just maybe more resources and education that we need to put into law enforcement to understand how this money is being sent and to understand it because this is such a new technology. I mean, crypto is fairly new to a lot of people.
So let me just make sure I'm understanding your last point there. These happen using crypto, is that right? And so are you suggesting that maybe better regulation here would be useful?
I'm not sure if I'm suggesting that, but what I'm saying is I think there's just a lot of misunderstanding about what crypto is, where it's going, how it's being used. I certainly know that a lot of the people who call our helpline don't even know it, even though they're investing in it.
Okay. So we need to do more to shut down these criminal gangs and to help the hardworking Americans who are losing their life savings to these scams every day. And I appreciate the work that all of you are doing. Thank you. Thank you, Madam.
Since my name was thrown around a little bit here in the last 15, 20 minutes on the issue of gains, I just want to present to my colleague that the real question is, are the very wealthy going to be taxed on the income they actually enjoy? And I think we're going to have to work through those issues, and I want it understood that I'm going to work with colleagues on both sides of the aisle to do that. Senator Warren.
All right. Thank you, Mr. Chairman. So our tax code is built on a very simple premise, and that is if you make it big, I mean really, really big, then you can afford to chip in a little more to keep our country going, to help pay for roads and bridges and child care and housing and the things we need. Today, that premise has been turned upside down. The wealthiest of the wealthy have figured out how to get richer and richer and richer and richer in ways that just don't show up on a tax form. The result, the top 0.1% pays about 3.2% of their wealth in taxes every year, while the bottom 99% pays more than double that. It's just not fair. So next year, Congress has a chance to unrig the tax code. Democrats have proposals to stitch up the loopholes that ensure, so that we can ensure that the wealthy pay their fair share. But, no surprise, the mega millionaires and billionaires are whining that they cannot possibly afford to pay taxes. So, Mr. Lord, you practiced tax law for nearly 40 years. You've advised wealthy clients on how to cut their tax bills. The richest Americans are now paying little to nothing in federal taxes. So tell us, are they not making any money?
Senator, they're making plenty of money, but the way they're making it is by holding assets that grow and grow and grow in value, you know, buildings, stock portfolios and such. And while that wealth is growing, the growth, which is economic income, is not subject, it's not even considered income for federal income tax purposes.
Right, but it's still good collateral for borrowing money.
Oh, it is, and actually they're able to borrow typically at very favorable rates because they have relationships through their business operations with lenders.
Okay, so let's go to that. Elon Musk, for example, raked in nearly $14 billion from 2014 to 2018, but he paid just 3% of that in taxes. Now, that's why the Biden-Harris administration has a proposal to ensure that people with a net worth more than $100 million, we're talking about the wealthiest 10,000 people in the country, that they would pay a minimum of 25% of all of their income in taxes. Now, we all recognize that is well below the current top tax rate of 37%, but the mega millionaires say it's still too high. They don't have the money because their wealth is all locked up in stock. So, Mr. Lord, are these 10,000 mega millionaires actually cash poor? Are they living like monks?
No, they're not. I haven't seen many monks on yachts. No, they're not. This is, as Chair Wyden pointed out, this is buy, borrow, die. When they need cash, they can get it. And as I said before, typically at very favorable rates.
So here are American families who are struggling to pay high mortgage rates and still pay their taxes year after year. Billionaires are buying private jets. Mr. Musk, for example, owns 4. So let us be clear. If you make it big, really big, $100 million or more big, I think you could afford to pay a 25% tax on your income. And just one other part about the choices we're making here. Mr. Dattagupta, you are an expert on economic policy and inequality. The Biden-Harris billionaire income tax would raise about $500 billion over 10 years. If we invested that money in things families need, like affordable child care or housing, what impact would that have?
Well, it would be transformative. These proposals that you have also helped champion, Senator Warren, could lower the cost of child care to just $10 a day for most families, helping parents work, helping kids get the early education they need. And research suggests that for every dollar we invest in high quality early care and education, we could recoup up to $12.
Wow, what an investment. So President Biden and Vice President Harris are fighting for families. Meanwhile, Donald Trump wants to take us even further in the wrong direction. He shoveled out $2 trillion in tax giveaways to the wealthy in 2017. And now he's out there promising that he will reward his, quote, rich as hell donors with more tax cuts next year if he gets the chance. And he and his running mate don't have a clue how to help with the cost of child care. Next year, we can afford to ignore the billionaire tiers. We can raise taxes on the wealthy, and we can invest that money in lowering costs for everyday families. Thank you, Mr. Chairman.
Thank you, Senator Warren.